Without any further ado, let us bring on the host of the Houston We Have a Problem YouTube show and podcast, Mr. Houston Wade.
Hello.
How are you?
I'm fantastic. How are you doing?
Good, man. Thank you for taking time to do the show. So a fan of the show and a comedian, Michael McCarthy, that I know, I've talked to him off camera about crypto, and he told me about he was involved with the GameStop. What is happening? I personally have been covering a lot recently about the FTX scam. Yeah. And I keep uncovering more and more stuff about Sam Bankman-Fried. That just seems like it just gets bigger and bigger, that mountain of corruption and fraud. And I think we're going to be learning about that for months, if not years. Yeah. But I wanted to bring you on the show because Michael reached out to me on social media about what is going on, and with, I believe, I don't know much about it, FINRA. And so admittedly, I don't know much about this at all. And so I wanted to bring you on the show because it sounds like there's a lot of similar type fraud, or some people are even saying this could even be a bigger scam.
I think it's a bigger scam personally. I think it's a lot more money. Yeah.
Okay. Well, why don't you do me a favor, and anyone watching who isn't as knowledgeable about this, again, I'm pretty much don't know much about it at all. So why don't you walk us through just from page one, exactly what this is, what is now happening. And then of course, at the end, what okay. People can do.
So to really start, we have to go back to sort of what the fundamentals were of the stock market back in the day, which is paper certificates. So when you bought a stock, your broker would order a stock from another broker, and then they would literally give a stack of sheets to a courier, and they would bicycle across Manhattan and deliver them to the other brokerage and then put those into your account, right? And that was a time-consuming process. It took hours, days for these things to clear and for the money to change hands and the paper certificates to get delivered. And so in the 1970s, the market got together and decided to create an electronic system that could do that. So these computers could just assign relationships to stocks as they got ordered. And the clearing process was quicker. You could do fast trading. And you could do all this stuff during the day. Then at night, the computer would rectify everything and move on. Well, one giant glaring loophole that got created in the electronic system was that you could sell stock that didn't exist. So, and with a paper certificate, if you wanted to short a stock, you had to call up, a mutual fund, a pension, whoever, and say, "Hey, I would like to borrow your shares, and I'll pay interest, whatever." And they would, send a messenger across town to your firm, give you the shares, and then you would sell them, and on the market, hoping the price would go down. And they go back into the market, buy up the shares at a cheaper price, and return them to whoever you lent from. And that's the traditional way of shorting a stock. With this electronic system, it allowed hedge funds, market makers, big institutions to actually go on the computer and sell shares of stock that don't exist. And the main computer mainframe at the DTCC, the Depository Trust and Clearing Corporation, which kind of handles all of these transactions, it allows it. So if I'm a hedge fund and I want to short a stock, I could go out and have pain in the ass problem. I'd go borrow shares from someone and pay interest rates, or I could just sell shares that don't exist and hope that I can drive this company into bankruptcy and never have to cover my position. So, and there's a big incentive to do that, because if you can get a company into bankruptcy and you never have to return the shares, you never have to pay any taxes on your play. You only pay taxes when you close your position. So your position never has to close. It's all free money. So if you can drive a stock from $100 down to zero, and you can do that with 100 million shares, you just made, $10 billion off of nothing, right? Because the stock goes to zero, the company doesn't exist anymore. How are you bother replacing those shares? So in the last 30 years, especially since the early 90s, short hedge funds doing these plays where they're creating counterfeit shares and inventing them out of thin air and selling them has become the norm. And they do it with a lot of mid-cap stocks and smaller. And recently we saw it happen with GameStop and AMC and Bed Bath & Beyond and a lot of companies you might see popping up in the news. And they figured that especially during COVID, when consumers weren't out going to shopping malls and stuff, they could just hammer these things down, and they could get them into bankruptcy and eventually into the pink sheets and never have to cover any of their positions. The retail investors kind of figured out, like, hey, if we just keep buying and holding and never panic and sell our shares, the market never further dilutes and the price doesn't go down, and the price might even go up. And if the price goes up, all of a sudden the liabilities get insane for these hedge funds. So you saw GameStop was at $2.57 in like April 2020, right? And then by January 2020, it broke above $450. And so for the billion shares that these short hedge funds had created out of nothing, all of a sudden they were facing $450 billion in liability. And we were about to collapse the entire American economy, because once one hedge fund went down and their assets got sold off, it would drop the price of bonds and stocks across the board, cause other hedge fund to go under, and so on and so on and so on. They're about to have a chain reaction. So the brokers got together and just panicked and said, no more buying of the stock. And they halted all retail transactions because it was the retail FOMO that was causing the price to go up. So that's analogous to what's going on now with MMTLP. So MMTLP started out as an oil company called Torchlight. It's a small little oil company. They have 200,000 acres or so in West Texas, sorry. And, 3 to 5 billion barrels of oil, few trillion cubic feet of natural gas. They got some proven reserves there. But during COVID, oil prices went negative because people weren't driving, they weren't flying, stuff wasn't shipping, and there was nowhere to store all this oil that's being pumped. And so they had to like pay people to take oil off their hands. And as a result, Torchlight, the share price went down, 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 down. And then the short sellers started piling on. And they started selling shares that didn't exist, causing the float to dilute and the price to drop even more, which would cause holders of the stock to panic and sell what they had to get what they can out of it, which would again cause the price to drop down. And they'd gotten down to something like 21 cents a share. And we're going to get delisted by the NASDAQ. And along came this Canadian tech company, this little material sciences nanotech company called Metamaterials. And they had launched in March 2020 their IPO in Canada. But their main product was this pair of eyeglasses for pilots that block laser light. So like 12-year-olds with laser pointers can't dazzle pilots. Well, they launched their IPO like 4 days after no one was flying anymore because of COVID. And their IPO just went flat. Like no one cared. So they're like, okay, let's wheel and deal. Let's see if we can get on the American exchange, get on the NASDAQ. So they contacted Torchlight and they said, hey, let's merge. Your company's toast. Our company wants to have a future. We want a listing on the NASDAQ. Let's just merge. Your shares will become our shares and we'll take over your ticker and that'll be cool. And so the deal got struck, shook hands, high five, whatever. And so if you held these Torchlight shares prior to the merger, you would get shares in Metamaterial, but then you'd also get these preferred shares that represented the holdings for all these oil wells and natural gas wells. And so that became the Metamaterial preferred share, MMAT1. And it was not supposed to trade. It was supposed to just be people's accounts and sit there until something happened to oil fields. And the idea was they're just going to sell it to Exxon or Chevron or someone. And it wasn't going to be that much money because oil wasn't worth spit at the time. So everyone's thinking maybe $1 or $2 a share for the 165 million of these shares. Well, since then, oil has skyrocketed. And now if they sell their assets, the dividend could be anywhere from $30 to $120 a share, maybe even more. And that created a bunch of people going, oh my, because a lot of these folks, like I paid 87 cents for mine, right? So if I can get $120 out of that 87-cent investment, rad. Like we're all stoked. Well, supposedly when the merger happened, all the shorts were supposed to close their positions in Torchlight because you can't carry over a short position when the QSIP changes and becomes another company. They're supposed to close everything. They didn't. And so a lot of people who have these preferred shares, MMAT1 shares, had fakes they just changed the name on them, and they were still a fake share. They're still counterfeit. And we don't necessarily know how many of them. The estimates are 200 to 300 million, maybe more. That of
300 million shares.
Yeah, there should only be 165 million of them, but it's likely there's 200 to 300 million, maybe more. They're in people's accounts. So October last year, a couple of market makers got together and they said, "Hey, you and I have a lot of short shares in this, and we're screwed if this dividend comes out, because if we have to pay, $100 per share on 300 million fake shares, that's going to bankrupt us." Right? So they got together, said, "Let's start trading this thing," and they just started trading it, even though in the filing it says not a tradable security, right? It's not tradable.
And this started, you said, in October of 21.
Yep. October
Okay.
6th, I think, or maybe October
Okay.
7th, somewhere in there. And it started trading as MMTLP, or the Metamaterial Torchlight Preferred Share. And it started trading like $3. And then they started shorting it down. So a lot of folks are like, well, wait a minute, this is weird. This is not supposed to trade, but it actually might be worth a lot of money. So folks started buying it, which meant a whole bunch of generation of even more shares were happening. And this went on all year until this summer. And the folks behind MMTLP, the old Torchlight folks, contacted FINRA, the regulatory agency. It's supposed to regulate all this stuff and say, no, this isn't supposed to trade. They contacted them and said, hey, why is this trading? It's not supposed to trade. And FINRA went, too late. That's basically their answer. Like, they're the regulator. They're supposed to say, no, this isn't supposed to happen. This is bad. Stop. But the chairman of one of the market makers that started trading was at the time on the board at FINRA, a guy named Ari.
Oh, weird. That's such a wacky coincidence.
Exactly,
oh,
right?
man.
Yeah.
That's so bizarre. That always happens.
FINRA isn't a government agency. It's a private company that's been granted powers by Congress to regulate the market. So they are entirely not related to actual governmental regulating. They make their own rules. They're made up of these members, these hedge funds and market makers that are policing themselves, of course.
This is literally, I talk about this all the time. It's literally like when police departments investigate themselves. It's akin to like, let's have the drug cartels regulate their drug dealing, and then I'm sure it'll be fair.
My cocaine's the purest. You won't get it any finer anywhere. Yeah.
Right.
It is not Drano and fentanyl, trust me.
No.
So for the last year, the stock's been trading, and it got hammered down below $1 for a while, and then kind of settled out at like $1.40. And in July, the Metamaterial group, they filed to spin off Torchlight, or as they were calling it, NextBridge at the time, but still trading under MMTLP. They decided to make it a private company, remove it from the stock exchange entirely, so that it's all privately held. There's no QSIP. There's no way to trade it. And so they filed with SEC, this form called S1, saying, hey, we'll make this thing private. And the SEC took a few weeks to look it over. Like, okay, there's a couple of things in here they need to change. So change these things, refile again. They did that. And like, okay, a couple other things got changed. They filed a third time. And after they filed a third time, okay, now it's been like 5 months. We need one more thing from you, which is an update of your financials, because we need up-to-date financials. Give us the last like 6 months of financials, and we'll be good to go. So they filed a fourth time, early November, and then like November 16th, the SEC said, cool, you're approved. You can go private whenever you announce it. So there had to be at least like a 15-day leeway for them announcing them going private. So they eventually announced, hey, we are going to stop trading the stock on December 12th. And on the 14th, anyone who still has their MMTLP shares will get new private shares in NextBridge. And all shorts need to close out their positions by the 12th, because you cannot have short positions on a private company. And everyone's like, woohoo, there's going to be a short squeeze, because there's a whole bunch of shares they got to close, and they have to do it by the 12th. We're going to be rich, right? I've got my 1,000 shares. I'm thinking they're going to be selling for hundreds, maybe even more a share, and I'll take care of my student loans, nice vacations, cool car, you name it. Okay, so the announcement's made. We now have this timeline of essentially like 2.5 weeks of trading days, and the price starts skyrocketing. It goes from your $1.40 to $12.65, I think was the intraday high, and then starts kind of levels out. The metamaterial guys are asking, and the NextBridge guys are asking FINRA to put out what's called a corporate action, basically giving giving the brokers and everyone sort of guidance as to what's supposed to happen. I mean, they know what's supposed to happen, but they need like the official word of God to say, this is your next move. And they wait and they wait and they wait. And finally, the Wednesday before, so this is Wednesday, the 7th, I believe. I'm looking at my calendar here. Yes, Wednesday the 7th, they finally released their corporate action. So it's 5 calendar days until the stock's supposed to stop trading. There was this corporate action says, hey, you got to close your positions. The stock's going private. If you want to buy tomorrow, the 8th is the last day you can buy and have your 2-day settlement period to make sure you are on the data record to get your NextBridge shares out of this. So you got just a couple of days and you got to start closing. And everyone's like, finally, now we're going to have this crazy short squeeze go on. The 8th happens. The stock price gets hammered from $9 down to $2.89. 13 million shares trade, 9 million of which are shares that don't exist. 9 million fake shares traded and hammered the price down. No one was forced to close. They allowed all the short sellers to sell as many shares as they want. And then at 1:30 a.m. that night, FINRA releases an emergency memo saying that they're halting trading on the stock with what's called a U3 order. Something that's only happened 3 times on an American stock in history. And it usually involves copious amounts of fraud, weird things where like insiders are suing each other. One time was a company that was doing a 100-to-1 reverse split. So they take 100 shares and make it into 1 share, and then immediately do a 10-to-1 forward split. And they're like, this is messed up. Like, we're halting your trading for a couple of days. So this U3 order is specifically designed for stocks that are supposed to trade in perpetuity, not for a stock that's going to stop trading in the end. And they cited what they called an extraordinary event. And they were protecting investors from this potential extraordinary event. And they said no trading until the stock stops trading on Monday afternoon and then becomes private, and that's it. You'll just get shares of NextBridge. The problem is if you have one of these synthetics, one of these counterfeit shares, you don't get shares of NextBridge. You don't get them. So you invested in the stock with maybe the intent to either get NextBridge shares or to sell during this forced short squeeze that's going to happen over these 2 days. And all of a sudden, they stop trading. Now, people complain to FINRA. They're like, hey, why are you protecting me from becoming a multimillionaire? You're claiming you're protecting investors. I don't feel very protected right now. I feel as though you just kept me from getting $1,000 to $10,000 per share and living on a beach for the rest of my life. Who are you protecting? Could it be possibly the hedge funds that now might have $2 or $3 trillion in liability? Because imagine 300 million shares selling for thousands of dollars each. You are in the trillions in liability. So that means all these hedge funds blink out of existence. That means the prime brokers, the investment banks, the Goldman Sachs, Credit Suisse, JP Morgan, Nomura, Merrill Lynch, whatever, they start blinking out of existence because they've allowed the system to create so many fake shares that the liability is completely impossible to cover. They can't. And so FINRA, in a panic, because I don't think they were really paying attention before, but I think that Thursday night after the stock price got hammered down 289, like, oh, let's just open up the book and see, just what kind of closing has to happen on Friday and Saturday, or Friday and Monday. And they went, oh my God, panic, stop trading. So,
because correct me if I'm wrong here real quick. I want to interject this. So if FINRA was paying attention and doing the job they're supposed to be doing, wouldn't they have way earlier in the process said, wait a minute, there's all these synthetic stocks, and this can't happen, to avoid this very situation from happening? Right.
The problem is that the American market is designed specifically to cater to those who destroy American businesses. That's how they make their money, right? You don't make your money. There's a couple of like IPOs where people are like, oh, it's a Facebook or whatever. But most companies in America are small and mid cap companies that trade over the counter. They don't need to raise that much money, but they might be a small company, 400 or 500 employees. They might do some valuable things, make a little gizmo for a car, a mining company or whatever. But the market, in the way this fast system was designed for electronic trading, specifically caters to companies trying to destroy other companies. And there's an entire industry built around it. So you remember the corporate raiders from the 80s and your Bain Capital guys like Mitt Romney and stuff. They're part of it. Basically, how it works is a company wants to do an IPO, and they get an underwriter. They get Salomon Smith Barney or Merrill Lynch or whoever to be their underwriter, and they launch their IPO. Well, Salomon Smith Barney or whoever might be with, they might do a deal, and it's kind of organized crime, with someone else and start short selling shares even before the IPO happens. They promise shares to other people and they lend them out, and this thing will get hammered from the get-go for most of these companies. And so they start hammering the stock down. Legitimately, they might be borrowing shares and flooding the market with those shares. But then they're like, okay, we don't want to pay taxes on this, and we want to maximize our profit. So what we're going to do now is we're going to start counterfeiting shares. We're going to sell all these fake shares that don't exist and hammer it down even more. Then we'll get the investors start panicking, and they'll start selling their shares. And then we're going to get a couple of our guys on the board of the company. So they will get some insiders of the hedge funds to be an executive VP, to be on the board, to be CEO, and they'll start destroying the company from the inside. They will bring in consultants like Boston Consulting Group to be like, hey, our company's not doing that well. Perhaps you could shed some light, and we'll pay you $50 million to tell us how to run our company. The Boston Consulting Group will hem and haw, and they'll give the same answer they give to every company ever, which is, what you should do? You should sell off all of your assets. That would be brilliant. Sell off all your assets and then rent back that same space for a fortune. So, and I know you own this $10 million in property in your warehouse that you're in. Well, if you just sell it for like $8 million and you rent it back for $1 million a year, that's probably the best business move you can make. And then they'll say, you know what? You don't have to worry about upgrading your storefronts. Just let that stuff rot. Fire half your staff. They're redundant. And all of a sudden, logistics start to fail. Orders stop going through. Customers stop going to storefronts. Your customer service starts going down. And you're paying a fortune in all of these rent and everything else you didn't have to pay before. On top of that, you might have your corporate raider come in where they'll do a leveraged buyout and then liquidate everything else, and they'll just post your entire company as collateral and take out billions in loans and give themselves huge bonuses, and then just walk away to bankruptcy, leaving your company to some bank that doesn't want it, right? And in the meantime, they're shorting the stock and they're shorting the stock and they're shorting the stock, hoping that everything goes into bankruptcy. And this happens to like tens of thousands of companies across the U.S. markets.
And this is why I just want to interject this real quick.
Yeah.
I mean, this is why the GameStop thing made them so mad, was they got burned at their own game. And the stock market is not designed for just regular guys like you and I to make real money. I mean, if you buy $5,000 worth of stock and it goes up to 20 grand and you sell it, they're like, fine, great. But they don't want you becoming a millionaire. They don't want me becoming a millionaire.
They prefer if you buy $5,000 in stock and it goes to zero.
Yeah.
They like that a lot more. Because it's designed to siphon the money from you and I, and then get stuck with these, fat cats at the top. And the buy and hold strategy has screwed them, because their entire attack on companies, these short attacks on companies, are dependent upon us panicking and selling and contributing to the dilution of the float.
Yeah.
But we stopped doing that in the last 2 years. We've seen multiple squeezes of all these little companies happen at the same time. So when you short a company, if you take a finance 101 class, they'll teach you about short selling, and your potential when you short sell, your hand gets in the camera there, your potential short sell, you sell a stock at this price, and if it goes down, you can make, that much money. But if people buy the stock and refuse to sell it back to you, and your shares get recalled, and whoever you lent them to you is like, look, I need my shares back. I'm going to vote. I'm going to sell them, whatever. You have to go in the market and buy them, and they don't want to sell it to you. All of a sudden, that potential for wealth you can make off that stock, the cap disappears, and there's infinite risk. Meaning, I don't have to sell my shares to you if I don't want to, but you have to buy them. And that's where we were on MMTLP, was I don't have to sell them, but you need to figure out how to get 300 million of them out of us, and that's going to cost you a fucking fortune. And that's where FINRA panicked, and they put the halt on, because they knew it was going to cost essentially, let's just say, 1/7 of the U.S. economy to buy back all these shares. That's just one of tens of thousands of companies in the exact same space.
So now So they've halted it. So any of you holders, you can't sell it back and make big profit. And they don't want you to pay off your student loans.
Yep.
They want us all in debt. That's why we don't have
Yeah.
free college, or
Yep.
like 39 countries have. It's why we don't have free healthcare like 100 countries have.
Yep.
It's because they want us in debt up to our eyeballs. And whenever there's an opportunity for regular people to make a big profit like this, like you guys found their scam, you're using their scam against them.
Mhm.
It's why they don't want people buying Bitcoin.
Yeah.
They want you panic selling it and dumping it. And that's why right now, this FTX thing, all the mainstream media, business channels, Yahoo Finance or whatever, they're all like, oh, this crypto is just a big filthy scam, because they want regular retail investors to dump their Bitcoin so that these institutional money can buy it up. Anyway, I don't want to go on a Bitcoin tirade, but that's why I'm a big proponent of Bitcoin specifically, because it gives regular people a chance to acquire wealth and get out of this rat race of work a shitty job, be in debt up to your eyeballs, and being basically an indentured servant to the ruling elite. Hey, everybody, thanks for watching. We are still in our 9th month of demonetization from YouTube. So support what we're doing at patreon.com/Graham Elwood or rockfin.com/Graham Elwood, which is a blockchain cryptocurrency platform. It's free to sign up, and there's a premium level at $10 a month. And for that, you get everybody on the platform's premium content. Myself, Lee Camp, Ron Placone, Jimmy Dore, Whitney Webb, Kim Iverson, Abby Martin, and many, many others. You can also support what we're doing at Venmo at Graham-Elwood, and go to GrahamElwood.com. We have a PayPal button and a PO box. I also have crypto wallets, which are all in the show notes. Thanks for supporting what we do.